financial ratios and how to analyze them. And we talk about these all the time. We'll dig in here a little bit about the details of why we follow certain financial metrics. And there's going to be 8 here, but I'll give you a few more similar metrics to follow that can be just as useful. So this is for individual stocks, analyzing individual companies. This is not when you're looking at an ETF or a mutual fund or anything like that. It's how to analyze the underlying business and how much you're paying for that underlying business. Okay. Now, earnings per share is the most commonly quoted metric, how much they earned last year. And it's simply calculated by dividing the company's net income by the total number of shares outstanding. Executives have a lot of control over the accounting practices. That means they can, in some ways, manipulate net income on a year-to-year basis, even a quarter-to-quarter basis, and thus earnings per share. So that's why you don't want to take earnings per share at face value. You want to dig into the details. The trends of earnings per share oftentimes doesn't tell you a lot about the underlying trends of the business. Why is that? Because, as I said, from accounting practices, that can manipulate earnings per share, but also that's on the net income side, but also the shares outstanding. So, for example, an executive can leverage up the balance sheet of a business, borrow a bunch of money, buy back stock, therefore reducing the total number of shares outstanding, but the profit of the business can stay the same, but it looks like earnings per share is rising. So understand that earnings per share, how it gets there, right? And what are the trends and why are those trends in place, okay? And that goes to P ratio. So that's taking the total company stock price divided by earnings per share. That's pretty simple. This is one everyone quotes. But once again, it's the earnings per share that can be manipulated. And then the market cap, the company's stock price, is not including debt. So understand that there are a lot of flaws in just simply analyzing earnings per share and P ratio. Okay. But you need to know how they're calculated. You know what they mean. You know that the inverse of the P ratio is the earnings yield, and you can compare that to other yields and other investments like bonds, et cetera. And you have to understand those concepts. Okay. Now, the third is return on equity. This is simply trying to calculate the return of a company generates on shareholders' capital. And it's calculated by taking the net income divided by shareholders' equity. The higher the company's return on equity, the better the underlying business. Now, that's just shareholders' equity. There's also called return on invested capital, which takes net income divided by equity plus debt on the balance sheet. Okay, the total capital that's going into the business, not just shareholder capital. Okay, and that's another one that can be useful as well, because return on equity can look really good if the company has a lot of leverage. And as you know, leverage can cut both ways. And so that's why return on equity and return on invested capital are both good metrics to follow. Now, then there's debt to capital ratio. This is when you want to understand how a business is financed and whether it can support its debt level. So it's adding short and long-term debt and divided by the company's total capital. Okay, so knowing how much of their capital base is debt versus equity. It varies depending on the industry. The higher the ratio, the more the company is in debt. You typically want it below 40%. But once again, it depends on the business. More cyclical businesses, you want those to be lower because their profits can go up and down. Steadier businesses, they can support higher amounts of leverage. Think utility companies. Talk about that all the time. Their profits are legislated, and so they can have a bit more debt. Then there's interest coverage ratio. This is simply by taking the EBIT, earnings before interest and tax, dividing it by the interest expense. So saying, okay, what is the underlying business creating in profits? And then can it support those debt payments? The higher the ratio, the healthier the business is. But once again, cyclical companies can handle that. They need higher interest coverage ratios versus ones that have more consistent businesses. Then there's enterprise value to EBIT. This is a good ratio, a much better ratio than a P ratio to follow, because enterprise value is not just incorporating the market cap of the company, but adding any additional debt or subtracting cash from its enterprise value. So the market cap might be, say, $100 billion, but if they have $20 billion in cash, Really, if you want to buy the whole company, you only need 80 billion, right? Because net, you're going to get 20 back if you bought the entire 100 billion, and vice versa. If they have $20 billion in debt, but the market cap's 100 billion, well, you don't really own everything when you buy the whole company for 100 billion and you still owe 20 billion, right? You still need to pay off that 20 billion. So that's why the enterprise value is a better metric to use than market cap. And then EBIT, just to more easily compare actual operating earnings of a business with other companies that may have different tax rates or debt. Operating margins, another great one, dividing by a total operating profit divided by revenues. That's a great one to follow as well.